Joining me now is Charlie Bobrinskoy, Vice Chairman and Head of Investment Group at Ariel Investments. Charlie, happy Friday. Good to see you. Are you shrugging off this little maelstrom in regional banks, or is it a sign of things that you're continuing to track?
Well, you should never shrug off credit issues. Credit issues are what drive bank returns, and they always come. Most of the questions that you're asking, John, have quantifiable answers in terms of data. I mean, we are seeing banks report, and there's a clear pattern, and that is that the lower end of the consumer market is feeling some stress, and we are seeing delinquencies be higher. Car loans in the lower credit quality consumer are ticking up, and that is going to be of concern. But then there are other institutions that don't have as much exposure to that. The JP Morgans, the Bank of America's, the Wells Fargo's tend to be higher net worth, and they are not seeing any stress. And then the other thing you can measure is just people get paid for lending to lower quality companies, and unfortunately, they're not getting paid right now. So what I'm worried about is that high yield spreads are at historically tight levels. I'm very nervous that we're issuing pay-in-kind zero coupon bonds, which is a sign that the company doesn't have enough cash flow to service its debt. And frankly, we have this new category of private debt that doesn't have the covenant protections that regular bank debt does. So there are things.
Break down for me why that's a worry for you.
Because banks can get paid back in a number of ways. They get paid if the company does fine. If it doesn't do fine, they need collateral behind it. They need covenants to be tripwires. And right now, the new banks, or the new non-bank lenders, the private credit people, are getting business by offering less covenants than the traditional banks. And they're doing it at tighter spreads. Those are all quantifiable statements. And so I do worry that this new credit people haven't gone through a debt cycle yet.
Well, Charlie, that's what I've been asking about is the degree to which the standards are lower for some of this, and that we might be greed exposed in the markets right here. Now, as long as employment continues to be high, as long as consumers, especially at the high end, continue spending, perhaps that covers a multitude of sins. But given the environment that we're in, should any of that suddenly slow down, are we exposed because of those very things that you just mentioned?
Yeah, so when you say we are exposed, there's clearly, in my view, going to be exposure in private credit. These new products that have grown so fast are just objectively not as well secured. They don't have the covenants that traditional, even high-yield public debt had. So I think that group of people are absolutely exposed. And then if we get a continuation of the challenges for the lower-end consumer, and frankly, one of the things that is going on, and I know this is a political statement, but it's true, is that the Hispanic community is not spending because, frankly, people are staying inside. There's people that are worried about being outside and being in the economy, and that's having an impact on the economy. So we are seeing those first, I wouldn't call them cockroaches. I don't think that's the right words. I think it's pockets of credit weakness.
Maybe groundhogs. Maybe, something else that you don't want to see, but not quite as icky as cockroaches. Well, given that, is there a period of time for the economy to keep humming and for these institutions to have a chance to cover that? I guess there's a question. You mentioned it's a problem for private credit, but the public markets are also trading at a pretty high valuation right now on good vibes. And if the vibes sour, that could affect more than just private credit, no?
Most of the great performance in the stock market has come from big, very strong companies. This is one of the things that's different. In 2001 and in the great financial crisis, we had some very levered companies that got in trouble. Now we've got people like Microsoft that are AAA credits at the top of the S&P. So I don't think we have a lot of exposure in the stock market. Frankly, the big banks are more focused on high net worth people than they are on the lower ends of the consumer. So I wouldn't personally put this at the top of the things to worry about. I worry about inflation. I worry about tariffs. I worry about deficits.
Right.
But I personally think the credit markets are in pretty good shape, again, with this carve out for this world of private credits. I don't think they're getting paid for the risk they're taking.